Most people assume winning in the stock market requires getting lucky. Market success actually demands rigid, unflinching emotional discipline, a truly rare trait. Warren Buffett built one of history's greatest fortunes by mastering this exact mental framework. Without this specific mindset, an account holder is merely gambling under the guise of investing. The trap of speculation is a timeless human flaw, visible in the markets for over a century. A speculator acts on emotion, chasing momentum and following the crowd into fleeting trends. The investor prioritizes long-term outcomes, committing capital only after extensive study and rigorous analysis. Identifying which path you are currently walking is the first requirement for avoiding financial ruin. Imagine a manic-depressive business partner named Mr. Market who offers to buy or sell stakes in your company every single day. During his euphoric moods, he demands unreasonably high prices. When he is depressed, he offers extreme bargains. This arrangement carries no obligation to trade on his terms or match his emotional state. Modern markets manifest as the digital roar of millions of flashing screens and urgent alerts. Mr. Market's high-speed evolution. These constant mood swings punish the emotional participant, yet they provide the disciplined investor with their greatest tools for profit. Internal psychology poses a far greater threat to your capital than external market volatility. Greed triggers the impulse to buy at the peak, while fear forces a panic sell at the bottom. Trading mechanisms, from vintage ticker tape to mobile apps, are designed to exploit these reactions through a constant feed of price information. Survival depends on intentionally doing the opposite of the crowd and maintaining total composure. Mastering your own impulses is the only way to break the cycle of buying high and selling low. The primary defense against market chaos is the margin of safety. This chart distinguishes a company's fluctuating market price from its stable real value. Execution of this rule requires waiting until the market price drops well below the intrinsic value of the asset. This protective cushion provides a mandatory defense against personal miscalculations and sudden market crashes. Adhering to the margin of safety shifts the activity of investing from a game of chance into an equation for protected growth. Making this entire system function requires the overarching superpower of extreme patience. Genuine wealth accrues through years of incremental growth, far removed from the allure of overnight success. Focusing exclusively on the power of compounding requires you to completely ignore the chaotic short-term noise of the daily news cycle. Time serves as the mechanism that converts your emotional discipline into massive financial leverage. Survival in the market rests on 4 pillars: long-term thinking, independence from the crowd, strict emotional control, and the margin of safety. Benjamin Graham, the architect of this philosophy, provided the defining perspective on the intelligent investor. The intelligent investor is a realist who sells to optimists and buys from pessimists. Examine your recent financial decisions. Are they driven by a disciplined framework, or are you simply reacting to the crowd? If you found this analysis valuable, please like, share, and subscribe to support the channel. Financial ruin remains an emotional choice. True wealth is the reward for choosing discipline.